Welcome back to Legendary Biz. You got a very special episode today. I got Kevin Davis with me. He's a financial planner. I will pitch it over to him to let him give his own introduction.
Good morning. Again, my name is Kevin Davis. I am a 1977 graduate of Jackson State University, originally from Gary, Indiana. Moved to Jackson, Mississippi when I was about 15 years old. Finished college here. When I graduated, I went off to Kansas City, Missouri with KPMG accounting firm. Worked with them there a couple of years. Came back and worked in Jackson, Mississippi with them a couple of years. Then ended up going to Tulsa, Oklahoma for 1 year, working for oil company as an internal auditor. And then on to Dallas for 1 year, working as an internal auditor with Atlantic Richfield Oil Company. After that, I decided to go into business for myself, initially doing income tax planning and preparation for individuals. Then about a year later, I started offering full financial planning services to individuals because they were asking for advice related to retirement planning and other things and investments. And I was also doing that for myself at an early age, so basically went that route and eventually became a certified financial planner, eventually became a certified retirement planning specialist, and also an asset management accreditation that I got at the same time. And for the past 40 years, I've been providing financial planning services to individuals and small businesses during that time frame.
Okay, so what made you choose Jackson State?
Jackson State, I chose Jackson State because when I was graduating from high school, we were practicing the ceremony, and one of the consuls asked me if I had a college scholarship, and I told her no, I did not. She told me to come by our office the next day, and based upon my grades and my ACT score, there were Jackson area scholarships, and it basically covered your tuition, and basically that's what I used to go to Jackson State on.
Okay, so I noticed you said you have a degree up in accounting. So what made you choose accounting and finance as your passion?
When I was about 12 years old, my father went into the service station business in Gary, Indiana, where he was able to lease an Exxon service station.
Okay.
And when I was about 15, when I moved to Jackson, I started doing bookkeeping and understanding how to put together profit and loss and do inventory and all those things for that time frame. And so I understood the concept of profit and loss. My junior year in high school, I took an accounting course, and once I took that course, I decided that's what I wanted to do, because that was my DNA, is to do accounting.
Okay, so the next question I'm gonna go into, ask you some advice about retirement. So what advice would you give somebody that's trying to plan for retirement, maybe they just graduated college and they started their job, and what's some things that they should be thinking about when they're preparing for retirement?
Okay, probably the big thing, if you're just coming out of, let's say 18 years old and trying to decide what you're going to do, one of the things I've found in talking to a lot of people is that a lot of people don't know at that point in time what they want to do. I think I was fortunate and blessed that I knew at a very young age because of my life's experiences and my father having a business. I knew that I was going to eventually go into some kind of business. I just didn't know what it was. But if I was 18 years old and recommending, I would say look at trying to do something that you enjoy and that you're good at.
Okay.
And then try to figure out, okay, what kind of degree does that lead to for that purpose? And then once you get that degree, then you can go out in the workforce, get experience in that, and then go down whatever road you want to pursue related to that.
Okay. All right. So most people don't actually know what a 401k is or Roth IRA. So can you go into a little bit about them?
Yeah, there are a number of different types of retirement plans that a person can invest in. Let's say you're out just getting started working, you go to work for a company, they typically have a 401k plan, which is basically a tax deferred program that you can put your money into, and then the company will also match up to typically about 6% of what you put into that account. And that's one of the accounts that probably 90% of people who work in companies invest in to use those assets to grow so that they can retire at some point in time and live off those assets that they've accumulated over time. Another type of account that can be utilized is an IRA account at the same time, where you can put, currently I think it's up to about $7,000 per year into that account. If you're over age 50, if you're under 50, you can put as much as $6,000 into that account on a tax deferred basis. Another spin-off between those two, you have what's called a Roth IRA or Roth 401k. And basically those two programs allow you to put money in on an after-tax basis. But if you let them accumulate over time, they become a tax-free account where you can pull money out at retirement on a tax-free basis. So it's good to have a number of different buckets of money in place so that you can pull from different ones depending on your tax bracket when you do retire.
Okay. So let's talk about some of the people that are close to retired and actually have retired already. So how should they manage their expenses once they're retired and to make sure they don't run out of money?
Okay, one of the keys to this whole concept of retirement planning and so forth is the key that I look at is plan.
Okay.
You gotta have a plan in what you're trying to do. The younger you are, the easier it is because you got many years ahead of you. The longer you wait before you look at financial planning, then the less time you're gonna have. A lot of times I work with younger people, and I think about some of my clients now that's in their 50s and they started with me in their 30s, and I do a retirement plan analysis for them each year. And I remember one young lady came in and said, you know, when I was much younger, I really didn't understand this to see how that was gonna have that kind of money when I'm 50, 60 years old. But once I got there, now I understand it. And she says it started clicking to me. So a lot of times you're doing things, you may not fully understand it, but if you're working with, you know, a good professional person, then you can do the things they ask you to do and get to the point where you can accumulate assets and be able to retire. Because one of the key things you want to do to be able to retire is to either have a cash flow for the rest of your life from a pension or Social Security, or have a lump sum of money.
Okay.
And the key from a simple perspective is that if I've got $1 million that I've accumulated over time, and if I only take out 4 or 5% of that, then I can take out $40,000 to $50,000 per year as income in retirement. And then if I got Social Security on top of that, and then if I have a pension on top of that, then that gives me a pretty good source of income that I don't have to worry about running out of money the rest of my life.
Okay.
So that's the key, is only being able to, you know, for personal purposes, having a lump sum money and basically be able to take out only 4 or 5% of that each year for income. And if you can do that, then you don't have to worry about what the market does from year to year, because right now we're going into, you know, tough situation this year because of the economy and the inflation and so forth that's happening.
Okay. I like that. It's real good. I know a wise man told me last year before I graduated to make sure you take advantage of the time that you got and get some compound interest, and also that your 21-year-old self really gonna be the person to take care of you in your older years. So make sure you start investing early.
Yeah.
So I really like that piece of advice.
Yeah. When we talk about compounding interest, when I do presentation, I call it the 8th wonder of the world.
Yes.
Compounding your money over time, the longer you're able to do that, the more you're gonna have. So if you start at a younger age and you look at the fact that I've got to, you know, work for the next 30 to 40 years, you've got a lot of time to do that. If you wait until you're 50 and you only got 10 or 15 years, you don't have that much time for your money to grow for you. So the younger you are, the better you are. I was fortunate enough, you know, at a young age to get into this business and understand it. And over time, it's paid out very well for me and myself on a personal basis as well.
Okay. So now I want to talk about you actually getting in and starting your business, because you started before, you know, all the social media and how easy information is to get about how to start a business and to get resources and stuff about it. Because for me, I just go on the internet and I type something in, and it automatically pulls up several articles and ABC of how to do something. How was that process for you?
That process for me, I started when I was 28 years old. I had been in the workforce for 6 years, worked at companies, understood how to put a company together and how to analyze companies and things. And what I decided to do was to go into, you know, because my background is accounting, income tax planning, income tax preparation. And then again, I spun off from that into financial planning because people were asking those questions.
Okay.
And then what I did before I even decided to open up a business, I did a lot of research, and that's what I recommend that anybody do before they go into something, is research your area. Because I talk to insurance companies, I talk to brokerage firms like the Merrill Lynch's, Prudential's, I talk to individual financial planners at the same time, and everybody that was doing this business to understand where I fit based on my personality. Because it's not just jumping out there, you know, where can I make money? It's a matter of looking at what do I want to really do in my life.
Okay.
And can I do something that I really enjoy? And I find that most people can't do that. And I was able to do that, and I went down a road that took a lot longer to build my business because I didn't build it from being a salesperson. I built it from being a consultant.
Okay.
Where I consulted with people, yes, I had investments and other things available for them, but I only used them if it fit what they were trying to do. So it took much longer to build a business, but I built a business with quality people, people that I wanted to work with, people that stood with me, because if you take care of people, people will take care of you.
Yes.
And then at the same time, you're taking care of them, then you don't have to worry about them leaving.
Okay.
And then also what happens over time is they start referring people to you, because some people talk to, you know, different friends about what they're doing financially. They say, well, you need to go talk to so-and-so about it, because it's almost like the same thing you do when you look for a doctor. You don't just go out on the yellow pages and find a doctor, but you ask people, who do you use?
Okay.
And that's what happens in this profession. So it takes time to build a practice. But if you look at the long-term benefits of it and understand that this business is, you know, you grow it over time, then it can be very rewarding for you the longer you're in the business.
Okay, all right. So now let's talk about some of the certifications you got. So what was your process of going about studying for your certifications, passing your certifications, and actually putting them to use?
Yeah, I got the first one I did. I was in the business about 4 or 5 years, and then I went back in. There's a matter of fact, when I was in college, I did a term paper my senior year on the different certifications that an accountant could get, and being a certified financial planner was
Okay.
one of those. But at that time, I had no, idea that's something I wanted to do. But 6 years later, I went into that business, and then after being in the business for about 4 years, I started studying for the Certified Financial Planning Program, and I did that on my own.
Okay,
But what I did prior to that, when I first started the business, I read probably 50 different books. I was reading magazines every month to learn everything I could about financial planning. And that includes insurance, that includes budgeting, that includes retirement planning, that includes taxes, that includes investments, that includes insurance, and also estate planning. So by the time I took the exam, to me, it was just crystallized that what I was doing for people was the right thing.
okay,
So it was just basically, and I just did the certification just to add credibility to what I was doing. So if somebody wanted to use me, then they know, I've gone through some testing for that purpose, to have that certification. So that's how I went about doing that.
okay. You just touched on some estate planning. So how should you be prepared for your estate planning?
Well, depending on your situation, even at a young age, a person should be doing some estate planning, because especially if you're married or even single, you should have at least some basic things like powers of attorney in place.
Okay.
One could be a general power of attorney. Let's say it's not about the fact that you're dead, but you could be here alive and be incapacitated.
Yes.
You can't manage your own financial affairs, that you want to have somebody that you have confidence in that can do that for you, where you give them power of attorney. If I can't do this myself, then I'm giving you the right to pay my bills, write checks, whatever the case may be. Another one to have in place is what's called power of attorney for healthcare purposes.
Okay,
Let's say you're in the hospital, you can't make decisions, then you want to have somebody, that you can give them authority to make those decisions for you, so that you can make sure you take care of. Because you may have the idea that say, okay, if I'm incapacitated and the doctor says, I'm not going to get any better, I'm just going to be in a vegetable state, you may tell them, we'll cut the plug at a certain time.
okay,
If I can't get better within 2, 3, 4, 5 weeks or a month or 2 months, then, let me go.
Okay.
Because I just don't want to linger on, being in bed. I know I had a client that, I think he was about 47 years old. He went out to play basketball, and he, I guess, had some kind of illness, and basically he stayed in a comatose state for about 7 years,
okay,
where he wasn't hooked up to machines. He could breathe on his own, but he was comatose for 7 years. And the only reason he lasted 7 years was the fact that his wife was a nurse. And
yes,
she was going by a nursing home, visiting him every day. So that forced the people that work there to make sure they were doing the right thing for you. So even at a young age, you want to have those kind of things in place. And let's say if you're married, the other thing that I'm finding with younger people, they see, they build up these 401k accounts. And when I tell them, okay, if something were to happen to your spouse that has a 401k account, and let's say you needed money out of his account,
yes,
you can't access that money unless you have a power of attorney to do that. You say, well, I'm his spouse, I can do that, but no, that's not the way the law works. The law says that you've got to have power of attorney to access those funds for that
Okay.
purpose. So that's even why at a younger age, and even in your 30s, you may have a 6-figure 401k account for your spouse, whatever. You want to make sure that each one of you can have access to those funds if needed, because you never know what's going to happen in life.
okay. Can you touch up on what a will and what a trust is, and why are they important?
Okay, a will basically is a document basically saying where you want all your assets to go upon your demise. When you start accumulating significant assets, one of the things you may want to look at is doing a trust.
Okay,
The difference between the two is a will becomes basically something you go down to the courthouse and you probate that through the county records, whereas a trust is a private document which you could put in place. You name a trustee, basically saying, okay, I want you to manage my affairs for me upon my demise. And let's say if you got children, people you want to go